Hi everybody and welcome along to the Mint Monthly Update for the Trans-Tasman Funds. We've got myself here today, David, talking to you through the funds and what was a interesting month of November. So just thought at the outset, it's been quite an interesting year and we're not quite at the end of it yet, but just looking at some of the charts and sort of the updates around what's happened, and you look at the charts below, and we know that it's been a strong market in the US. We're looking at that range. We're at sort of some of the best performing markets, so the S&P 500 we've seen in some time. But interestingly, you look at the chart on the right, and we obviously know with what's been a well publicized election in the US, that confidence in US markets and outcomes is still very high. So even though we've had a storming year in terms of history for the S&P 500, it's quite interesting to see that even from here, we're now seeing some pretty positive confidence and outcomes for next year. But bringing it a little bit closer to home, the New Zealand SRI Fund. Now the New Zealand market had a pretty strong November, actually up 3.5% nearly. This was driven by a couple of different factors. One, of course, being the well expected but nonetheless positively taken rate cut from the RBNZ, delivering 50 bips as expected. Additionally, we did see rate cuts offshore in the US too, but the key one was New Zealand. In terms of how the New Zealand fared, interestingly, it was the REITs in terms of property space that actually underperformed, but the sectors that performed well were some of the large caps around FBH, Auckland Airport, and Contact Energy, some of the stable, bigger names. But in terms of why it was the case, I mean, from some of the larger ones in town, we did have reporting from Fisher & Paykel Healthcare. They reported a pretty solid update. Now, there's a lot of expectation going into it. The share price had rallied hard, but they delivered revenues of almost 20% growth in line with guidance. Probably a tad higher on the revenue line, but from an impact line, roughly in line with where people were expecting. Now, I guess in the first half, they had strong performance from their hospital division, up 21%. And seeing sort of strong growth in the new app revenue up 25%, which is showing good uptake of some of their key products that they've released in the last while. The portfolio products they have released in the last year has been particularly strong. Additionally, their home care revenue was also decent, up 14%, looking at about a 16% growth in the OSA masks and other key area. They're doing continue to do well. And again, the improvement in gross margin we saw through the business was in line with the expectation, also supported further down with some solid operating expense control, which is tracking great. In terms of guidance, largely unchanged. And obviously it's a bit dependent on the flu season, talking up a moderate flu season in their guidance from here. In terms of other updates, we saw Mainfreight did provide another update. Obviously, they'd pre-guided at their Investor Day last month. The only surprising factor there was they did pull CapEx back a little bit, obviously trying to align growth in the business with the growth in customers. So obviously we know still a little soggy out there at the moment. And other names as well, Ryman was probably the big disappointer overall. Obviously a bit of a soft update in terms of high levels of inventory, not selling through their units, and also the mix of inventory they continue to hold tends to be more service departments, a little bit harder to sell. But the big disappointment really came back to their cash flow targets in terms of their FY25 cash flow break even. They slightly walked away from that, delaying that back a bit further. And that's been a key disappointment given that cash has been a large focus of the sector. One of the names that had a very strong month was actually Gentrack, up 40%, unbelievably, for the month. Now, a big part of this wasn't the result itself. That was reasonably in line. In fact, at the impact, a little bit soft, but that's largely to do with some LTI costs. Neither here nor there. But the big share price response was really around the CEO's comments in terms of their 15% CAGR revenue targets, that potentially could be upgraded in the near term due to sort of lack of competition and a great pipeline out there. So obviously the stock's gone well, but continued to go well and rallied hard into that update. In terms of other names out over the month, we did get an update at the AGM from A2. The surprising feature there was actually around a bit of a positive revenue lead. Now that was around excess sort of ingredients being sold through the MVM business, so not high margin, if any at all, but supportive of revenue. But the key one is really around the dividend policy, which was introduced by the board, 60 to 80% payout of NPAT. Now that was a bit of a surprise. I think people expected them to have spent some cash on supply chain efforts first, but obviously the board took comfort in the large, over almost $1 billion of cash, and thought that was more than enough to survive both those metrics. So it's had a good strong bounce on the back of that. So we'll look forward to its next update. But obviously the chart on the screen there showing what the reporting season, we summary from 4 there. And as you can see in the bottom two rows, the big red piece there, while reporting was pretty average, actually the guidance in terms of what next year and the year after and what analysts therefore did, it's pretty negative. We saw some pretty decent. EPS was down 10%, but again, further downgrades through to the next 2 years was a little bit softer than some had expected. Now rolling over to our Australasian fund, to be fair, this was some similar stories to the SRI fund, but where we saw some key performance supporting features for the fund was around a couple of names. Now Telix, pharmaceutical business out of Australia, continued to perform very strongly over the period. A couple of reasons for that, one being its effective dual listing or a secondary listing on the NASDAQ, which was supportive, but also a key decision by CMS around the funding payments for their procedures and products, and to do with an unbundling that helped support some product. Just an example, about 20 to 30% of their patients effectively only get paid about a 20% of the normal payment for, so this was pretty material and supportive. And additionally, they actually ended up purchasing a business that operates within their wider portfolio, but in the bladder cancer space. Obviously, Pacific Edge is one that operates in that area too, but this is more around both diagnostics and therapeutics around the existing products that they have. So very supportive, and the share prices continue to trade well. Megaport was another one as well that provided an AGM update over the month. They just reaffirmed guidance, but I believe, with the expectations rather low in that name, it did see this share price rally and continues to do well. Additionally, one of their key competitors, Packet Fabric, also, started unwinding and is having some struggles there, and they managed to steal some key sales staff from there as well. So that's been interesting. Another name that had a bit of action over the month was Channel Infrastructure. They raised $50 million through a rights issue, largely around funding growth capex for a recently signed private storage contract, 15-year contract worth about $45 million over the contract. That's actually with Higgins, the Fletcher Building subsidiary, around a bitumen storage project. So again, another name that continues to perform well and continues to grow at a little incremental pace. And then just moving on to property, as I touched on earlier, property actually had a reasonably soft month, down 1% for the month. Now, overall, it rallied for a couple of months into this. And again, it's not necessarily the front end of the curve, the OCR cuts that drive property valuations. It's often the sort of 5 to 10 year of the curve. So hence why I've popped up that chart on the screen there, looking at, where are we priced in terms of the sector at the moment. And obviously PE is a reasonably crude measure for the sector. But if you look at where the red dot is on the screen there, it's not necessarily implying that the sector is particularly cheap. But obviously we know that interest costs are starting to come back, as we saw through the reporting season just gone, and that continue to support the sector to some degree. So in terms of the reporting from the sector, we did see a couple of different bits of news. In general, tenant demand was a little bit soft, and obviously saw some vacancy tick up, especially around secondary office, tends to be particularly slow. And additionally, rental growth slowing a little bit across a few different areas, both industrial and office. Additionally, we did see from the positive side, debt costs starting to levelise or decline, depending on the hedging across the sector. And also cap rates starting to stabilise, having expanded over 100 bips in the last few years. But in terms of the result, in terms of what we just saw, dividends remained rather stable, although EPS was a little soft. In fact, EPS over the reporting season was about -7 for REITs, so not particularly strong. Of the names that did report, GMT reasonably a tad bit higher in cash earnings, looking okay there. But that was partly to do with a bit of a reclassification of one of their assets. But in terms of the overall backdrop, industrial is softening a little bit. Obviously, they are at the quality end of town, but we are sort of seeing some small insolvencies within their portfolio. So we saw vacancy tick up a touch. Obviously, as I said before, quality assets in general, but it's obviously a bit of a challenged sector in the medium term. Additionally, from KPG, we saw another reasonably solid update from themselves in terms of rental growth, just over 4% and more like 6% from the mixed use portfolio. Operating costs were reasonably solid as well, under control, down to sort of 13% of their net property income, largely through some cost out and lowering overheads as well. There was an interesting transaction announced as part of the result as well, with a small or modest investment in a asset management platform called Mackesy Property. And I guess this is sort of part of the plan we've seen in others moving to the more capital light asset manager model, but also from a KPG perspective, also provides potential capital source, i.e. selling some secondary or less core assets over time. So, that'll be reasonably interesting to see for them, especially with their gearing at the higher end, closer to 38% currently. One of the more disappointing results within the REIT sector was actually Stride. AFO is down nearly 30%. Sounds a lot worse than it was in reality. A few one-offs in the prior period made for that looking particularly bad. But I guess in terms of the ambitions as a asset manager as well, there's still some interest in getting capital partners in this part of the world, but it is taking a bit longer, and obviously falling rates will help that. But for Stride at the moment, they are reasonably restricted. Also, similar to KPG, their balance sheet is rather tight at the moment throughout some of the underlying vehicles as well. So while it sits on a gross yield of almost 9% at the moment, some of the assets, it's a little challenge through there. And thanks very much again for dialing in and for your time. I'm wishing everyone some happy holidays over the break, and hope everyone manages to get away and enjoy themselves. But as per normal, if you have any questions, please send them through to info@mintasset.co.nz, and enjoy the break, and we'll be in touch soon.